Most people think choosing a higher deductible is a smart way to save money. And yes, you did receive a lower premium for the same coverage. Easy decision, right? But here's what most policyholders don't realize. That $1,000 decision can turn into a $10,000 mistake fast. Today, I'm going to break down how deductibles really work, when higher deductibles help, when they hurt, and how the wrong choice can wreck your cash flow at the worst possible time. So let's get started. What a deductible actually is. First, if you think the savings from a higher deductible is worth it, we need to talk about the reality. A deductible is the amount of money you agree to pay out of pocket before your insurance steps in. Now, let me be clear. The insurance company actually withholds your portion of the deductible before the claim check is mailed. For example, if your deductible is $1,000 and you have a $12,000 loss, you pay the first $1,000, the insurance company pays out the rest, which is $11K in this case, assuming the loss is covered. That part is simple. What's not simple is how deductibles stack, repeat, and multiply across real-world situations, which brings me to this: how a $1,000 deductible becomes a $10,000 deductible. Here's where people get caught off guard. Let's say a windstorm damages your home. You file a claim, but the loss doesn't stop there. You have roof damage, interior water damage, temporary repairs, mold remediation. Multiple repair trades are involved. If the policy has separate deductibles or percentage-based deductibles, you may be paying more than once. Many carriers apply higher deductibles for wind, hail, or named storms. There may be a $1,000 deductible for all other perils, but your wind and hail has a 2% deductible based on your home's insured value. For example, a $5,000 home at a 2% deductible creates a $10,000 deductible, which is the same as $10,000 coming out of your pocket before insurance pays a dime. However, there is a time when high deductibles make sense. Conversely, high deductibles are not always bad. They can make sense when you have strong cash reserves, you rarely file a claim, you want protection for major losses only. If those cases apply to you, higher deductibles can lower premiums and reduce claim frequency, both of which matter long term. The key is intentionality. As long as you understand the reality, a high deductible should be a financial strategy, not a surprise. When high deductibles hurt the most, high deductibles become dangerous when you don't have liquid cash available. You have multiple deductibles applying to one event. You're dealing with lost income, displacement, or repairs. And when you find yourself in this situation, people will delay repairs, put costs on credit cards, or skip claims altogether, turning insurance into something they pay but can't use. So we need to understand the total situation and know how to choose the right deductible. This is the conversation most agents have trouble getting clients to understand. The right deductible depends on your savings, not your income, your risk tolerance, not your premium, your property type and location, and your exposure to weather-related losses. I walk clients through real scenarios, not just numbers on a quote, because insurance should work when life doesn't play fair and not add to the stress. Be prepared for the unexpected. Don't let deductibles be the weak link. A deductible isn't just a number on the policy. It's the first check you write when something goes wrong. And if you're not sure what your deductible means or whether it fits your financial situation, this is a review-worthy event, especially if you're not sure. Now, if this content was helpful, please share it with someone who may benefit from this topic. And don't forget to like and please subscribe to the channel. But don't stop here. Check out the next video right here for more insurance and financial tips. And as I like to say, call Jay today. Thanks for listening.